Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, May 16th, 2025. S&P 500 currently sitting at 59.21. I'm David Zolling here with Ian McMillan. Pretty big market development this week, Ian, wouldn't you say?
Yeah, we certainly saw a lot of improvement over the last few weeks, and that has continued to hold.
You know, last few episodes, maybe going back 4 weeks, was about the importance of clearing the 5,600 to 5,800 level. Our clients are familiar with that. As I started the podcast with, we're now at 59.21. And so it is pretty informative that we went directly through that level, reclaimed the election gap that we've talked about, currently sitting at the zero line. So where we started the year.
Of course, they had to do it on an overnight gap.
Yes, gapped it right up.
Monday morning gap, and everything's fixed. Voila.
Yeah, I mean, to clear those levels as swiftly as we did, still below the all-time highs. So there's still overhead supply that we're coming into here near the 6,000 level. So it'll be interesting to see what buyers and sellers do there. But a great first step if we're going to move on to new highs, which is the most bullish thing this market could do. But clearing a 200-day, clearing an election gap, clearing the July 2024 highs, not a bad start, but it's got to hold. Now it's about sustaining trade above this level, because if we're back below a 200-day, which is currently sitting at 57.60, then it's risk off again. But for now, great sign this week that buyers have control of this market.
Yeah, very strong moves. I think you've seen it in a lot of sub-industries and individual stocks as well. A lot of the same leaders that we had coming into the February highs, I would say, so far, you know, if the lows have been put in and we are on our ways to new highs and a new leg in this uptrend for the cycle, I would say a lot of the leaders from post-election through February kind of emerged as the leaders again as we navigate our way out of this.
Mm-hmm.
Probably not the biggest surprise, right? And I'd say one of the best examples of that would be like a SPMO.
Yeah,
momentum, right? So momentum is typically going to hold leaders relative, well, you know, depending on your time frame, so over some type of time frame, or that is that short, intermediate, long term. You know, the idea is what has outperformed in the past will continue to outperform, and that strategy across many ETFs, the momentum kind of mindset, has really had a nice recovery itself.
Yeah, for sure. The momentum factor that we've been highlighting for the past few weeks is definitely alive and well, and maybe was the clue that the corrective behavior wasn't going to go any further. Because from a big picture perspective, it wasn't that long ago where we were talking in February about maybe there's one more flush to go to the downside, and was March and April was that the flush that cleared out all the weak hands, because we already had bearish sentiment on our hands. You know, whatever readings you were looking at, whether you're looking at the AAII survey, positioning, there was a lot of negative sentiment going into that. You get the flush and subsequently have this quick of a rebound. I think you do have to pay attention and say, oh, okay, that's, you know, especially if the way a technician works in a thesis is, hey, around 5,600 to 5,800 in the S&P, that is where you would expect sellers to show up.
Yeah.
And the fact that they didn't at this point in time,
haven't yet.
That's information.
And I would say we got similar behavior in 2022 in regards to price action, but I don't think we had any breadth thrusts in 2022, like on that first.
In March of 22?
Like March, and then we and then we got above the 200-day for a little bit and then rolled back over again. I don't think there were any like Zweig breadth thrusts or anything like that. Not that I recall.
No, there wasn't.
So that is something that's different. I see that kind of analog get thrown out there a lot, and it's valid. I mean, it's certainly, I mean, it's a recent occurrence in the back of people's minds, like, oh, well, we recovered quickly in 2022, and then, 9 months later, look where we were at. Definitely true from a price action perspective. Underneath the surface, definitely feels like we're ready for another uptrend.
Well, and to your point about leadership too, it's interesting to note how well growth is holding up versus value. Momentum is holding up as a factor. You are seeing some leadership out of tech. You're seeing the false breakdowns that we talked about as being a possibility are underway for technology versus S&P and semiconductors using SMH versus S&P. And for context, when you look at those relationships, let's use technology XLK versus S&P, had been consolidating since May of 2023. So really no alpha or opportunity advantage of being in tech stocks since that time. We had that flush in that relationship in March and April.
Yeah.
And quickly reclaimed it. Could you see tech lead the rest of the year? Definitely a possibility at this point. If you were to draw it up.
Semiconductors have also had a nice rebound.
Yeah. And so the rotation into large cap tech and large cap growth would look like this. I mean, you look at something like XLG, which is the top 50 S&P 500 stocks from a cap weighted perspective versus the S&P itself, consolidated and held up nicely through all of this. Was that a clue at the time that your cap weighted, which is another way to view momentum, right? If your large cap pieces are holding up and momentum is holding up, was that a clue that this was a good consolidation with a flush and the table is set for higher prices until we close back below 5,600? That's probably the case. Now it's about sustaining this. Sustaining trade above a 200-day, sustaining trade above 5,600. That's really the clues we're looking for on whether this market has staying power. And there's potential overhead supply. It'll be really interesting to see how the broad market handles these levels that are coming up near 6,000. Time will tell. It's good to have a process, though.
It is. One thing I want to follow up on we've been talking about this for a few weeks. Definitely got a lot of attention. I'd say we talked about it for probably a couple of weeks, but definitely got more industry attention this week was the the technician would argue that it's been falling apart for a few months now. But our healthcare provider stock, well, not ours, but the healthcare provider stocks. We talked about them last week, particularly United Healthcare. Terrible week. I think just even yesterday, UNH was down 33%. Is that right? Something like that.
Yeah, it's down 27% on the week as we record this. And to your point, that didn't come out of the blue if you're a technician, right? The main carnage actually started back in mid-April, about a month ago, hasn't relented, broke really important levels near $450 on the stock.
So just the last 5 weeks, it's down 60%.
It's a lot. That's a lot, Ian.
That is a lot for a pretty large stock. At one point it was number one in the Dow. Over the last year or so, it had worked its way down to number 3. I mean, we know Dow is a price weighted, and I don't know why.
Well, and it dropping in price like that would reduce its weighting in the Dow Jones. And now that it has to get 120% to get back to even from where it was in
number
April.
10 now.
Number 10.
Number 10 at $276 a share.
Wow.
Yeah, and that has been a big, big, big headwind. I mean, the Dow, we talked about this 200 days and election gaps and zero lines and things like that because we focus on the S&P. But the Dow, it is above a 200-day, not above
by the skin of its teeth,
not above a zero line and it's sitting in its election gap. I wouldn't say it's the most enthusiastic move like we saw in some of the others.
Mm-hmm.
But Dow, yeah, terrible. And then, of course, I mean, no surprise, right? So hovering around, relative lows. And Russell has not fixed a lot of things either. It's still pretty far away from its 200-day moving average. Back of the pack, that should surprise.
Yeah, it's been the case for a while now.
Yeah, I think we'd like to see, it would be cool to see things like banks or biotech. Speaking of healthcare, biotech looks atrocious on a relative basis. So are we back in the Magnificent Seven things, semiconductors theme? That looks to be the case.
Right. It will be interesting to see if small caps versus S&P 500 can hold up right in here, because this is from the inception of IWM, the ETF for small caps. This is back to the origination in that relationship from May of 2000. It'll be interesting to see if small caps can gain any traction here. But right now, it still remains large cap growth, large cap tech. Definitely some things underneath the surface for healthcare with UNH. I'd even make the argument, though, that there may be a narrative coming out of those healthcare insurance companies, because it's not just UNH. We talked about Elevance, we talked about Cigna,
yeah,
CVS, Humana, also weak during this. Not to the degree that United Healthcare is, but it does make you wonder if there's a bigger story coming from healthcare insurers. What that story is, I have no idea, but price is certainly indicating when you've had the market rebound like this since April, this aggressively, and healthcare does not participate at that degree at all, there may be a narrative coming, and would be classic, right? Because price moves first, then you get the narrative. That's really what you get.
Has not participated. Wednesday, it hit year-to-date absolute lows. So, yes, weak on a relative basis, but going, and this is a broad sector,
right?
Going the complete opposite direction of every other sector. I mean, they're even buying staples. Now, staples aren't going up to the degree as the index. It is. I also didn't fall as far, but absolutely want nothing to do with healthcare. And it's nothing new. I've had the healthcare workbook for, I don't know, however long, at least the past month, and it's terrible. Every time I see it in my calendar, Dave, I roll my eyes, because I know it's going to be a terrible looking charts.
You got stuck with cleaning the bathrooms on the chart chart is what you're saying.
I would say, as far as things that are working, I think industrials are intriguing.
Yeah.
Year-to-date relative highs, close to it. Might have to zoom in on there and get some work, but it has looked pretty good. It's above a relative 200-day. Obviously, aerospace and defense looking pretty good there.
Well, and financials continue to hold up well.
They do continue to hold up well.
Those are coming into an important area, and so if you're sitting there, analyzing risk on, risk off metrics, the fact that we're going to buy industrials and financials as a market whole, I don't know that you get to say that that's risk off. And then you add in the international picture, which is mixed. I know doing international work that the downward rate of trend is still intact.
Yep.
For things like EFA, VEU versus S&P, some of your broader measurements of international equities versus the S&P, there's been a downward rate of trend that's been in place for well over a decade. And seeing that rejection this week, are we seeing a rotation back out of international and into large cap US?
It seems like it. It's, another, say, boy crying wolf for foreign stocks. I mean, they look good. They look fine on a absolute basis.
Yes.
Like the DAX looks fine. So it's sitting up at all-time highs. Is the DAX going to outperform? It's a good question.
It is a good question.
But yeah, I know you've said, and I think you might have mentioned it earlier, if we were going to do this, if we were going to get everyone spooked, get out, run to European equities, right? Because at least what's going on in Europe. They don't have a crazy orange man just putting tariffs on everyone, right? So we'll just go hide out in foreign stocks. Now are we on the chase back to American tech? Yeah. If you were an offensive coordinator and you wanted to draw it up, and probably how it would look, huh?
Yeah, it would. It would look a little bit like this. So we'll see in the weeks and months ahead. We really have to hold some of these levels in these relationships. The false breakdowns that have happened in tech versus S&P, semiconductors versus S&P. You now have to hold up, follow through on this. And so now we're in the follow through phase. It's a really, like you said, it's a really good first step. Time will tell. And it's at this point I do want to highlight the supporter of this podcast, the Adaptive Select ETF, which is listed on the New York Stock Exchange under ticker ADPV, which helps investors access two of the most prevalent factors in markets, momentum and relative strength. Using proprietary identification methods, the Adaptive Select ETF attempts to own the strongest 25 large cap stocks when the market is in an uptrend. And since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends. Investors can find out more, including how to invest in ADPV, by visiting adpvetf.com or calling 1-833-880-5200. Investing involves risk, including possible loss of principal. ADPV is distributed by Quasar Distributors, LLC. Where do we want to take it from here, Ian? Do we want to touch base on stores of value, maybe crypto or gold?
Crypto holding up well. Are we before we go there, I do think it's important to talk about the dollar. So big move in stocks this week, right? We talked about Monday. Also big move Monday for the US dollar index. We're back above 101. So that big range that we've talked about for a few years now, really.
Right, yeah.
We are back in that. So we had an overshoot to the upside and late last year, and then now an overshoot to the downside. So back in the channel.
Back in the range between 100 and let's call it 107.
Yeah.
That's been in place since 2022. That's definitely a possibility. Now we'll see. I mean, this 100 to 101 level is important. Needs to confirm and get above that level, but it's a good observation that the dollar's back into this range.
So what's that? Yeah, what's that going to mean for our, as you said, stores of value?
Well, I think it's impressive how well Bitcoin held up even during the equity correction. It had its own correction. I don't want to make it sound like it just was from the lower left to the upper right on the chart, but Bitcoin did hold up. It's now currently trying to hold, relative highs. So when you look at Bitcoin versus S&P itself, it cleared the levels that we saw in January of 25, December of 24. Do we hold that now? Time will tell. That'd be a really important level for Bitcoin to hold. And on an absolute basis, Bitcoin's right there. It's right at that 104 to 107,000 level, consolidating very tightly the past few days since the beginning of May. Time will tell. But I would say gold cooling off.
Gold definitely cooling off. Now, hasn't gold priced in dollars. Yeah, definitely cooling off, especially on a relative basis. Had a very strong move. Still out of this base breakout. So if I look at the point, I'm looking at GLD versus S&P. So we had this multi-year base breakout in early March. Are we coming back to visit that? I don't know. Yeah, over the last few weeks, definitely an underperformer. And stronger dollar probably not helping that. I would assume so. Maybe we're back to buying gold and foreign currencies.
I think it was just fair to say that a few weeks ago we talked about how extended gold was, that it may not be something to have a new position in because of how extended it was. And this is the nuance of risk management. You could have had a position earlier, and it's fine if you're still holding and still in an uptrend. But how extended it was just a few weeks ago, really hard to take on a new position there. But I fully realize, commodities move like that. Commodities tend to have a higher beta to them. I do find it interesting, even looking at like the relationship of Bitcoin to gold, how Bitcoin broke out versus gold to new highs and is holding it well.
It is very nice, healthy consolidation. And maybe that's what we'll see out of equities here.
Right. A little bit of sideways, a little bit of digestion after this move. Hold the 5,600 to 5,800 level, maybe test the 200-day from the top side and then go. That'd be healthy. Nothing wrong with that. I do want to talk about a ratio we haven't talked about a lot, copper gold ratio.
Copper to gold.
Right,
What about
Dr. Copper? Well, I think it's interesting when because the premise using intermarket analysis is risk on, risk off, or cyclical, right? If copper's outperforming gold, that tends to be economic expansion. If gold is outperforming copper, then we're talking about risk off. I don't know if I necessarily buy that in the middle of the distribution, but if you do look at copper to gold at extremes, we appear to be there right now. So if you look at HG copper futures versus GC gold futures, I mean, we're at levels that we saw at the bottom of the great financial crisis and the bottom of COVID.
Wow.
So is this indicative of a place where you do see economic expansion? I don't know. I
think you could throw August 2016 in there too.
Yeah, that's true. That was also a significant low.
Yeah, we had that sideways range for a few years, and then leading up into the election, recovered and off to the races.
So we'll see. It's an extreme level, a level we've only seen a few times over the past, 15 years. So is this a place where copper starts to outperform gold and is indicative of economic expansion? I don't know. I'm not a big macro fundamental guy, but using a chart could possibly be the case. You'd want to see that ratio hold this level. Otherwise, maybe it is indicative of further risk off if it's breaking down through these levels that have held as support over the past 15 years. What else, Ian? I know we're bumping up towards the end of our time, but any other areas you're seeing strength? I know you talked about some industry leaders in the past. You could talk about strength or weakness, doesn't matter to me.
I'd say the same. Video games were strong before the correction, still really good. We talked about aerospace and defense, gaming and gambling, cybersecurity, internet. I think PNQI, if I remember that from my workbook yesterday, PNQI looks pretty good on a relative chart. So definitely your same kind of techie, internet-y, no help from Homebuilders.
Yeah, Homebuilders pretty anemic. If you were to line up your weight of evidence out there, on the one hand, like you said, you've got risk on tech, FANGs, online retail, video games, even some of the AI names are back, or crypto, those companies involved with crypto. But then you look at something like XHB for Homebuilders, hasn't really responded the same way the rest of the market has. Might put that in the bearish category, that if we're looking back 6 to 12 months, and if we are in fact lower prices, was XHB telling us about it ahead of time? Could be. But again, you'll never check all the boxes either direction. It's just not how it works.
Nothing from transports either.
Right.
We'll see. Don't have to have them. Don't have to have them participating.
Well, it is interesting to see if you look at IYT versus the S&P, we undercut the lows from February of 2004, which were the all-time lows in that relationship. And we've since reclaimed them. If that's a false breakdown that mirrors all the false breakdown themes that we've seen, do we see a resurgence in transports? I do wonder, you still look at Home Depot versus the S&P, or Lowe's versus the S&P. Those still have some work to do. I mean, they're right at a precipice where you'd like to see demand pick up here. And you can't have everything, but those are some nice things that you'd want to see. But to your point earlier, be perfectly normal. The fact that we slice through the 5,600 to 5,800 level like butter is information. But do we consolidate here? Because we are getting near, we're back to break even on the S&P. We're back to the zero line, the January 1st price. Do we pause here? Do we go up into the highs and test those levels? Time will tell, and we'll make sure to tell you guys about it when you tune in next time. Anything else, Ian, you want to cover before we wrap this one up?
I do not have anything.
All right. Well, I appreciate you doing these with me. I know our listeners appreciate it. And if you do enjoy these, please share them with your friends. Give us a high ranking on your platform of choice, and we will be back next week.
Have a great weekend, everyone.